Can you really pay 0% capital gains tax in the UK? Well, HMRC would rather you didn't, but there are still plenty of perfectly legal ways to slash your bill. And in this video, I'll show you exactly which ones still work in 2025. After years of helping small business owners, I can tell you many people pay far more than they have to simply because the rules keep changing. Allowances down, rates up, confusion everywhere. Let's start with what used to be a generous tax break, and now it's barely a weekend away. A few years ago, you could make $12,300 in gains completely tax-free. Then it dropped to $6,000, and now for 25-26, it's just £3,000. That's not an allowance, that's a rounding error. But that's HMRC for you, quietly trimming away your tax breaks while pretending nothing's changed. It's a bit like that chocolate bar you left in the fridge that somehow it gets smaller every time you check, and everybody swears they've not touched it. But here's the thing, even though it's been gutted, it's still $3,000 you don't have to pay tax on. And if you're married or in a civil partnership, that doubles to $6,000 between you. The trick here is timing. Split your disposals across tax years. Sell one asset before the 5th of April and another after. That doubles your exemption instantly. Just make sure the disposals are completely independent. You can't flog the same asset twice unless you're in crypto and you enjoy chaos. It's definitely not going to buy you a yacht, maybe a paddleboard at best, but it will legally shave thousands off your capital gains tax bill. But what if you could double that allowance again without selling twice or waiting a year? Here's the sneaky little secret HMRC doesn't exactly advertise. You can literally double your tax-free allowance overnight. How? By using the one person who already shares your Wi-Fi, your kettle, and probably your patience, your spouse or civil partner. Transfers between spouses are completely free from capital gains tax. So if you give part of an asset to your partner before selling it, HMRC pretends they bought it at the same price you did. Now that means when you sell, you both get your own $3,000 exemption and both sets of tax bands. And with CGT rates now 18% for basic rate and 24% for higher rate taxpayers in 25-26, that's not just doubling your allowance, it's potentially keeping more of your gains taxed at the lower 18% rate instead of tipping into the 24%. Now that can easily save hundreds, sometimes thousands, depending on the size of your gain. Of course, this only works if you're legally married or in a civil partnership, not just sharing a Netflix password in a houseplant or a strong sense of denial about whose turn it is to put the bins out, just saying. And you'll want to record the transfer properly. A simple gift letter or an email trail your accountant can log is enough. If the asset has a title document, you need to update this as well. But what if you don't have a spouse to hand assets to? Don't worry, the next strategy helps you save tax by changing when you sell, not who owns it. When it comes to capital gains tax, timing is everything. The UK tax year runs from the 6th of April to the 5th of April, and CGT is based on the date you actually dispose of the asset. That's when the sale legally completes, not when the money hits your account. Now here's why that matters. If you sell an asset on the 5th of April 2026, that gain is taxed in the tax year 25-26. Sell it just one day later, 6th of April 2026, and it rolls into the 26-27 tax year instead. That one day difference gives you a fresh $3,000 CGT allowance and an extra year, more importantly, before you have to pay the tax. It also helps you manage which CGT band you fall into. If you expect a higher income year ahead, let's say you're selling a property or cashing in some shares, or you're taking larger dividends, well, delaying until after the 5th of April could keep you in the basic rate band and save you thousands. Or if your income's likely to drop, maybe you're retiring, just scaling back, or maybe taking that gap year you never had. Shifting the sale into that lower income year could cut your CGT rate from 24% down to 18%. And if you really want to get strategic, the next step is how to use your losses to cancel out your gains altogether. Now, If there's one thing HMRC actually lets you use to your advantage, it's your bad investments. When you sell something for less than you paid for it, whether that's shares, crypto, or that can't miss property that absolutely missed, that's a capital loss, and you can use it to cut your tax bill. Here's how it works. Let's say you made a £10,000 gain selling some shares this year, but you also lost £4,000 on crypto. You can offset the loss, meaning you'll only pay CGT on £3,000 gain, since you've still got your £3,000 tax-free allowance that's available to you. That's a saving of up to £540 just by declaring a loss you were probably trying to forget about anyway. And it gets better. If your losses are bigger than your gains, you can carry them forward indefinitely. So a bad investment from 2022 could still help you reduce your tax bill in 2026, as long as you tell HMRC about it. HMRC somehow knows every detail of your income, but when it comes to your losses, they develop selective amnesia. You've got up to 4 years after the end of the tax year to report a loss. So for anything in 25-26, the deadline is the 5th of April 2030. And while we're talking about keeping more of your gains, there's one place HMRC can't touch them at all. Inside an ISA, an ISA, or a pension. That's next. If you want gains HMRC can't touch, use the wrappers built for exactly that. Let's talk about ISAs first. Anything you hold inside an ISA, cash, funds, shares, grows completely free from capital gains tax and income tax. For the 25-26 tax year, you can put in up to 20 grand, spread however you like across cash, stocks and shares, or innovative ISAs. There's a bit of gossip about the government trimming the cash ISA limit in the next budget, but as of now, nothing's changed. So if you've got savings sitting around outside an ISA, it's worth wrapping them while the full allowance still exists. Think of it as putting your money in a tax-proof bubble before the government finds a new way to pop it. Next up, pensions. Inside a registered pension, your investments grow tax-free too. And since the lifetime allowance has been scrapped, the key limits now are the £268,275 lump sum allowance, the 60k annual allowance for pension contributions, and the £1,073,100 lump sum and death benefit cap. A lot of numbers there. In plain English, you can now build a much bigger pot before the taxman gets a sniff of it. So yes, ISAs and pensions protect your investments. But what about your home? It's often your biggest asset of all. If you're selling your main home, the one you actually live in, you can usually claim private residence relief, which means the gain is completely exempt from capital gains tax. But of course, it's HMRC, so there are caveats. If you've ever rented part of it out, used it for business, or moved out before selling, that's where things get messy. You might only get partial relief. For example, if you owned a property for 10 years, lived there for 8 and rented it for the last 2, only 80% of the gain would normally be tax-free. That said, the final 9 months of ownership always count as exempt, even if you weren't living there at the time. So if you've moved into your next place before selling the old one, that last stretch still gets covered. One more thing most people miss, HMRC doesn't automatically know which property is your main home. And if you own more than one, you can actually nominate it yourself. Do that within 2 years of owning more than one property, and that single form could save you tens of thousands in tax. So if your home is your castle, make sure HMRC know exactly which castle it is. But what if the property you're selling isn't your home? It's an investment or part of your business. That's when you need to look at the next strategy. Reliefs designed specifically for business owners and directors. Let's start with one of my favourites, BADR. Really BADR name. Business Asset Disposal Relief. It used to be called Entrepreneurs Relief back when the name sounded a little bit more heroic. Under BADR, you pay a reduced 14% capital gains tax rate on the first 1 million of lifetime gains. That's up from the old 10% rate. Yep, the government's been quietly bumping it up, and it's scheduled to rise again to 18% from April 2026. So if you're thinking of selling, completing before that date could literally save you thousands. Now, if you're not looking to sell to another buyer, there's another route that can make you sell completely tax-free. It's called Employee Ownership Trust, or EOT for short. Instead of selling your shares to a third party, you sell a controlling stake over 50% to a trust that holds the business on behalf of your employees. And if you meet the conditions, the entire gain is exempt from CGT. It's a brilliant option if you want to reward your team, protect your legacy, and still walk away without the tax bill from hell. And if you're not selling a business, but you still want to pass on wealth to your family, your kids, or even a charity, there's a clever way to do it without handing HMRC a slice. Now, most people think giving things away just means losing value. But in tax terms, gifting assets can actually save you money if you do it right. When you give away an asset like shares or property, HMRC normally treats it as though you sold it at market value. Now that means in theory you could trigger capital gains tax even though you didn't make a penny, because apparently generosity still counts as a taxable event. But there are a few situations where you can defer or even eliminate the tax altogether. If you're gifting business assets such as shares in your trading company or farmland or certain qualifying properties, you can claim holdover relief. That basically holds over the gain, deferring it until the recipient sells the asset later. So instead of you paying the CGT now, they inherit your original cost and pay the tax when they eventually sell. Of course, the trick is getting it right. The asset has to qualify, the paperwork has to be filed, and you both need to agree to the claim. Miss a box on the form and HMRC will treat it like a normal sale and send the bill straight to you. So before you start handing out shares like Christmas presents, get proper advice and a solid paper trail. Because a well-structured gift, it can protect your wealth for decades, but a sloppy one, well, that might cost you a small fortune overnight. And speaking of fortunes, there are a few assets you can sell for profit and pay absolutely no capital gains tax on at all. Most people don't even know these rules exist, but they're written straight into HMRC's own guidance. First, the wasting asset exemption. Now, this one sounds odd, but it's basically HMRC's way of saying, if something's going to fall apart anyway, we're not going to bother taxing it. A wasting asset is anything with a predicted life of 50 years or less. So things like cars, boats, caravans. Now this doesn't apply if the asset was used for business. For example, if your company owned the car, but for personal stuff, it's fair game. Something to consider when you're shopping for your next Sugar or Red Rum. Sorry, show my age now. Then there's the personal possession exemption, also called the chattel exemption, which it just sounds so medieval. If you sell a personal item or a chattel for $6,000 or less, there's no CGT at all. Now that includes things like jewellery, paintings, antiques or collectibles. Even if the item sells for more than $6,000, there's a cap on how much CGT can apply. It's designed so that selling a family heirloom isn't treated like day trading. So if you've ever sold a piece of art or your grand's silverware and you're worried you might owe tax, you probably don't. And before you start raiding your granny's attic, they might sound like small wins, but these are exactly the kind of details that separate the people who overpay HMRC from the ones who play by the rules but keep more of their gains. All right, if you've made it this far, here's your reward. The bonus round of CGT reliefs most people don't know exist. These are quite niche, but if you ever tick the right boxes, they can save you thousands. First up, rollover relief. Sell a business asset and buy another within 3 years and you can defer the gain completely. Think of it as pressing pause on your capital gains tax until you actually cash out. Next, incorporation relief. If you transfer your sole trader or partnership into a limited company in exchange for shares, you can roll the gain into the shares, so no tax now, just later when you sell them. Basically, you hand your business to the company, take shares instead of cash, and the tax politely waits in the corner. Then there's investor relief. It's like business asset disposal relief's quieter cousin. Same 14% rate, fewer conditions, but you'll need to hold the shares in an unlisted trading company for at least 3 years. Not one for the impatient. Now, the charity exemption. Gifts to UK registered charities are completely free from capital gains tax. So if you want to do good and dodge tax at the same time, HMRC actually approves of that one. Another one that HMRC has kept quiet is certain gold coins are completely exempt from capital gains tax. That's right. If you buy or sell gold sovereigns or Britannias, there's no CGT to pay at all, and gold is moving. Why? Because they're classed as UK legal tender, not investment assets. And finally, negligible value claims. If an investment has gone belly up, say the company's gone bust, you can still declare a capital loss even if you haven't sold it. If it's worthless, you might as well get some relief for the pain. The truth is, capital gains tax doesn't have to be confusing or unfair. It just feels that way when you don't know the rules, because paying tax is inevitable, but overpaying it isn't.